baby, what's going on? Morad Fiki, how's it going? Happy St. Patrick's Day. Today is St. Patty's Day. And so it's an incredible day. I got my green on. I wasn't even planning. I didn't even know it was St. Patty's Day. And I wore my green shirt. That was so cool. You know what I'm saying? So hope you're having a fantastic day. Hope everything's going great, and hope you're taking action to be productive, to be passionate, and to take progress towards your goals. I even saw this magazine right here. Look at the green. I love that. So, yeah, it's a fantastic day, St. Patty's Day. Are you drinking green beer? Make sure if you're drinking green beer, you're at the gym in the morning and working out and work it off, right? So other than that, I wanted to talk today about the interest rates. Interest rates are going up. The Fed has just announced a quarter basis point increase in interest rates. Now, what does that mean for you? Like, why do you care? Why does that even matter? And I'm going to show you this over time. I'm going to show you over time, where have interest rates been over the last 62 years? And we're going to show you, I have a little graph that I'm going to run. It's going to be fantastic. And I'm going to explain why this is important for you, especially if you're thinking about buying or selling real estate. And if you're on the fence, or someone on the fence, just waiting till rates go down. It's not happening. It is not happening, and I'm gonna prove this to you. So let me bring up my screen. This is actually, I'm very passionate about this. If you can tell, this is actually a very, very interesting topic, and I'm gonna prove why the myth of interest rates going down is not happening. So let's go ahead and share my screen. Can you see that? Let me make sure you can see that. Yes. Excellent. All right. So I'm pulling up here a chart that is showing interest rates, the historical data of where interest rates have been during the last 62 years. So almost during the last century. And I'm going to show you, and I'm going to prove to you why the rates actually have been uber low for the last many, many years. So this goes all the way back to, now we're going to look at, let's see how far this graph goes. We're looking at July 26, 1954. Can y'all see that? Okay, July 26, 1954. This was after World War II, and the economy needed a comeback. It was after the war. Our boys and girls who fought valiantly were coming back home or had been back home. And this is the years after the war was a big boom in the economy. And you can see this. In 1954, we're giving a quick history lesson. 1954, the rates were at 1.38%. And you can see over time they kind of fluctuated. Here you had August 30th, August 20, July 26th, they're a quarter of a percent. Wow. And then at 1.38%, 1.25, half of a point, you see they're fluctuating. But over time, they started going up. You see 1957, 58, see where they're still relatively low. Here at 4% in 1959. And then they went again for another downswing. The Fed has a lot to do with that when they control monetary policy. And depending on where the Fed puts the basis rate, where they put the Federal Reserve interest rate, this is the rate at which banks borrow money from the U.S. government. And you can see, depending on where the rates are, that's where, because the banks have to lend out money higher than the rate they're borrowing money, and they make that spread. So you can see they're going up. This is 1966, up in the sixes, touching the 6.6%. Then they went back low again, and now you see they start to rise again. Then they were here at 7, 9%, 1969. Here in the 70s, again, they went back for another downswing, going back up as high as 10% in 1973. You can see 1974, they went up to 13.31%. Can you imagine getting a loan and costing 13% is your interest rate? That's if you have excellent credit and you put 20% down. Then going back down again in the mid 70s, back to the sixes, 4.73% in February of 1976. And then they went up again, coming back for another upswing, back to the high tens. Then boom, this is when Ronald Reagan was president. I was born in around this time. I'll let y'all guess. But look at that. 20%. Can you imagine a loan at 20% interest rate if you have excellent credit and more than enough income to pay for that? You're paying so much money in interest right here. This is actually ridiculous. And so, why would they raise the interest rate so high? Well, they got to stop inflation. And right now we have 7% inflation. That is killing your savings. So, I think that's the highest that it's ever been at 20.61%. And that was June 15th of 1981, 20.61%. And then you can see, boom, we went on another downswing. I mean, it just had to come down because houses aren't going to sell at that. If the loans are 20.61%, what do you think the market does? What do you think buyers do? They're all backing out. Like, I'm not buying a house. It just makes more sense for me to rent right now. Because if you're going to pay triple or quadruple your house payment, like, what's the point, right? So that right there kills the real estate market. That's where I want to bring this point. When there's high interest and borrowing is very expensive, it kills the real estate market. As far as sales, it makes more sense. That turns into a renter's market where it makes sense to own apartment buildings and apartment complexes because everyone's going to rent, or even rental houses. So now you see the rates started coming back down. That's when President Reagan instituted Reaganomics because he had to bring those rates down. It was crushing the economy, right? 9.9% in 1989. And then boom, we went for another downturn in interest rates. 1991, the 90s, back down below 3%. Wow. And then here we go back to this, high fives, mid fives. And these are in the 97. And then the 2000s went back above 6%. And then we went for another downswing in the early 2000s, back to the 1.69% and even lower. This is the early 2000s. Wow. Can you imagine getting a loan at 0.98%? Like, that's incredible. 0.98% is like a free loan. That's a free loan. I would borrow as much as I could, even if you can pay all cash for a house. Why? When they're going to give you a free loan. And then here we get back up to the starting to go back to the mid fives in 2007, back down to the low. And then can you imagine a 0.15% interest rate? This was when was this? This was after the financial crisis, 2008, the financial crisis, when Wall Street and all of these toxic wrap mortgages, these toxic assets went bad. To stimulate the economy, they had to cut the interest rate. And if you remember, during this time, the Fed dropped it down to almost nothing. I think it was at zero because they had to get the economy going. This was a huge recession. When you see the low interest rates, you can see that's where the recession is. Can you imagine borrowing at 0.08%? That is a free loan. So again, back to the 2015, and here the rates starting to go back up again. 2017, 2018, 2019, COVID-19 hit. So rates were still low. And now 2020, Let's look at the last 6 months. Okay, or the last year. So the last time the rate was raised was, let me see, this is a tenth of a point. Okay. So they've been flat for a long time. So the rate is going to go up. This is a fact. This is just a fact. The rate is going up, period. And so, whether or not you like that, whether or not you want to hear that, the rate is going up. They just decided that they are increasing the rate by a quarter point. That's the first time they've raised the rate for the last 3 years. Now, what does that mean to us? What does that mean in the real estate business? That means if you are considering buying or selling, if you're thinking about it, as rates go up, the cost of loans are going up. And as interest rates go up, buyers start backing out. And for a number of reasons. One of them being that, look, they're going to, because it's more expensive to get financing, buyers are going to back out. And so, if you're thinking about selling, I would get the house on the market right now while it's the spring, while rates are still low, but they're going up. Now, some people are saying, you know what, we're going to wait until rates come back down. They're not going back down. With inflation at 7%, with the rate have not being raised for the last 3 years until yesterday, they raised the rates. They're going to continue slowly, incrementally increasing the rate to get control of this inflation. And as the rate goes up, as the Fed interest rate goes up, banks are going to start increasing interest rates on loans, which means purchasing a house is going to get a little more expensive. And, if you want to lock in that ultra low interest rate, better buy now. If you want to sell for the highest money possible, better sell now. And that's my word of advice. That's just what is happening. And if you also look during the last 60 years, there's only been 2 times that rates have been below 6%. And we're currently in one of those times. So a lot of people think, well, I'm going to wait till they go back to 2%. It's not happening. That is ultra low. That was like record low interest rates. Who knows if it'll even go back that low during our lifetimes? Who knows? No one has a magic ball, but 6% is really the regular rate. Anything over 6% is high, and lower below 6% is low. So we're still at low record rates. Sell or buy if you're thinking about doing it, and do it now. Don't wait. Get off the fence. Summertime is around the corner. Let's do this. I'm happy to help you analyze your personal strategy and help you make the best decision for your family. Reach out to me. Let me know. Comment, like, share, and tag me. Let me know, and we'll jump on a call. We'll look at your analysis. Consider me your real estate advisor. I'm here to advise you so you can make the best decision for you and your family. And so with that, I'm super happy and excited for the weekend around the corner. Make sure you take time for health, wealth, and success. And I can't wait to see you next time. Peace, love, respect.